Good afternoon, everyone, and welcome to our October webinar. The scrolling slides that you saw moments ago filled you in on CEs and other important information about this and other webinars. If you missed that, go ahead to the education pages on our website to check that out. Today's presentation is about disability insurance and how to mind the gap. As we go through the presentation today, feel free to submit questions on screen, and we'll get to them as we can throughout the webinar. Then at the end, we'll open the phone lines up for individual questions if you raise your hand on screen at the end. As always, this webinar is being recorded, and it will be posted to our website within about a week. Today's presenters are Kathy Copack and Mark Maurer. Kathy is our disability insurance specialist, and she's been in the insurance industry since 1982. Having spent 10 years with Celtic Life managing the company's operations and corporate regulatory compliance. And she then joined Low Load in May of 2005 with 12 years of agency experience as Vice President, Practice Management, Marketing, New Business Development, and Agent Training. She's got a medical background, and that's a bonus to your clients as they navigate the disability underwriting process. Mark Maurer is a member of the National Association of Insurance and Financial Advisors and a popular speaker for financial organizations including the Alliance of Cambridge Advisors, NAPFA, Garrett Planning Network, LIMRA, LOMA, and the Society of Actuaries. He's also a contributing insurance resource to industry publications including Businessweek, Bloomberg.com, Forbes, NAPFA Advisor, AMA Physician's Guide to Financial Planning, and Jane Bryant Quinn's book, Making the Most of Your Money Now. He is the president here at Low Load Insurance Services, and he is living proof that sometimes tradition is a good thing with Keith and Judith Maurer at the helm. So without further ado, I give you Kathy Copack.
Thank you, Dina, and thanks to all of you for attending this afternoon. What we're going to cover this afternoon is how to recognize the gap. If you can't recognize the gap, all you have to remember is to call me. I will help you find it. Why is it important to cover it? Because you don't want to leave your client unprotected. We're going to talk today about taxable versus non-taxable. This basically means who's paying for the coverage. We're going to talk a little bit about comprehensive coverage for base salary and bonus commission and how group insurance looks at that. We're going to spend some time on occupations and classifications and why that's important. And we're also going to spend a little bit of time on looking for features such as guaranteed renewable, non-cancelable, and portability in individual plans. And we're going to spend a little bit of time on some other coverages that are available and what happens when we can't provide individual insurance. What are our alternatives? Now this particular slide you've probably seen before, and the only emphasis I want to make on this is simply that everything rests on your client's ability to earn an income, especially here at the bottom where we indicate health insurance. Keep in mind that if your client is totally disabled and is terminated from their employer, they will be responsible for their health insurance. In other words, they will be making COBRA payments, so we need to make sure that when we're looking at our disability coverage, we're taking that into consideration. Now I'm going to talk about what I think are some thought-provoking statistics and why we need to cover the gap. First of all, 65% of working Americans say they could not cover normal living expenses for a year. Furthermore, 38% could not pay their bills for more than 3 months. Additionally, medical problems contributed 62%, or 500,000, of U.S. personal bankrupt filings in 2007. Also, just over 1 in 4 of today's 20-year-olds will become disabled before they retire. In the past hour, almost 3,000 Americans became disabled. Kind of staggering to think about that. In the past hour, that's 49 disabilities every minute. In December 2010, there were over 2.5 million disabled workers in their 20s, 30s, and 40s receiving Social Security disability benefits. Now, what is the gap? The gap is the difference between a group plan will provide in benefits and what an individual is eligible for. The gap is sometimes created because commissions and bonuses are not covered by the group individual plan. Also, it may have a cap such as 60% to $5,000, and it's taxable. So if you can't quite figure out where the gap is, just remember, call me. Okay, let's go over a little example of what you're going to be looking for as you review your client's group disability plan. So your client has an employer-sponsored group long-term disability plan. Pay attention to the word employer-sponsored. That means it could either be employer-paid or employee-paid. It may be taxable, which means that the employer is paying for it. It may be a situation where it doesn't cover all their income, such as bonuses or commissions, and it might be capped. Like I said before, a lot of plans say 60% to a cap of maybe $5,000, $10,000. We said 98% of the time. That's because 98% of the time, that's usually what it is, 60%. Sometimes you'll see 66%. In addition, these benefits are offset by Social Security. So if someone's collecting $5,000 and gets $1,000 from Social Security, the benefits from their employer is only going to be $4,000. And sometimes all of these are affected by your disability plan. Next, we're going to give you some identifiers on how to identify the cap. The easiest way for you as a financial planner is to look at your clients who are generating an income of $100,000 or more and have group insurance. Beyond that, again, if you can't find the gap, just remember to call me. We also have a policy review service that we provide, and in order to find that, just simply go to our website and go to Advisor Tools, and you'll see policy reviews, and there's a column simply for disability. Who's eligible to supplement their disability plan? Most any employee with an employer-provided disability coverage, and most government employees are eligible for some sort of supplemental disability. The reason we say some government employees is simply because federal government employees are usually in what is known as the FERS plan. FERS stands for Federal Employee Retirement System, and they have an automatic disability plan that provides for 60% of their pay the first year and 40% thereafter. Now, let's look at an example of how to identify the gap. This first case is a sales manager who's 40 years old. He makes $75,000 in salary and $75,000 in bonus. Before we go any further, I think the most important thing that you need to point out to your client is if they feel that they have group disability insurance and that they don't need to worry about anything else, that's a big red flag. Most clients will probably figure that if they have group disability that they're getting 100% coverage. We all know that's not the case. It's probably closer to 60% of their pay. Secondly, as you see here, this individual has got a salary of $75 and a bonus of $75. Most bonuses and commissions are not covered by disability coverage through their employer. So that's the second thing we need to identify. And last, there's a cap. Again, if there's a cap of $5,000 or $10,000 and they're beyond that, they're not going to get anything beyond the $5,000 or $10,000. So let's take a step further and look at this particular situation. We've identified he has a $75,000 salary, $75,000 bonus. His take-home pay with his combined income of $150,000 is $9,375 a month. His group coverage is 60% to $5,000. So right away we need to take into consideration the bonus is not covered. So what he is getting covered is his $75,000. Well, because $75,000 doesn't meet the $5,000 cap, his actual group benefit at 60% of his pay is $3,750 or $45,000 a year. But we need to take into consideration that it's employer paid, so that makes it taxable. So his actual amount that he's going to be taking is $2,812.50. I hope everybody can follow that. Just remember, about 25% discount against what he's currently bringing home on the $3,750 is going to net him $2,812.50. So we have a gap. of $5,700 that we've identified. So what we're going to do here at Low Load is try to figure out a way to provide him with an individual plan that will supplement the $5,700. And what we were able to do is provide him with $5,700 of tax-free individual coverage at an annual cost of $2,823. Okay? And how much did that cost? Grand total between the how much is the monthly benefit he's actually going to get now? He will receive $8,512.50 a month if he should become disabled, which is the $5,700 he's going to get from his individual plan and the $2,812 he's going to net from his group plan. So all told, he is approximately $863 short of his take-home pay. Again, he's taking home $93.75, and we're going to provide him with $85.12 of coverage. Pretty impressive. All right, let's take a look at another one. Here's a gentleman, same one, who's doing much better. He's making $150,000 in salary and $150,000 in bonus. Clearly, he's increased his sales skills. So here again, we're going to divide them both up. Keep in mind that the bonus is not going to be covered. We're going to take a look at what his take-home pay is between the $300,000, and he's bringing home $18,750 net from taxes. He's got group coverage, which is great, 60% to a $5,000 cap, which is not very good when you're making $300,000. So again, we've X'd out the $150 because right away we know the group coverage is not going to cover that. And we have a cap of $5,000, so he has $7,500 a month that he brings home, and the $5,000 cap, this one should be pretty easy. What we can supplement is $12,350. So how much is the $12,350 going to cost? We were able to provide coverage at an annual cost of $6,117. So grand total between the $12,350 that we were able to provide on the group and the $5,000 that he's able to get with his individual, or his employer-sponsored plan, he's able to bring home $17,350 a month if he should become disabled. And if you take a look at that versus his take-home pay of $18,750, you'll see that he's within $1,400 of his take-home pay. Again, pretty impressive. All right, we're going to look at one more where a bonus is not built into it. It's just pure salary, CPA doing pretty well for himself. Let's see what we can get for coverage for him. His take-home pay is $18,750. He has a group plan through his employer that pays 60% to a $10,000 cap. This is going to provide him, obviously, with only $10,000 since he's already over the cap. His take-home pay, like we said, is $18,750. So his net after taxes is approximately $10,000. And the gap in this situation is $8,600. And we were able to provide him with $8,600 of individual coverage at an annual cost of $3,640. And if he should become disabled between his group and his supplemental, we're going to provide him with $18,600 in disability benefits. And again, his take-home pay is $18,750. And you can see we got him within $150 of his take-home pay. All right, let's move on to a different topic, occupation definitions. This is a really important topic because it does affect both group and individual policies. The first one we're going to talk about is own occupation, very rarely seen in a group disability plan. It's used primarily in an individual plan for very specialized and high-income medical professionals and executives. You know, obviously surgeons, you're going to see having the ONOC definition. Their definition just simply means that if you're unable to perform the substantial material duties of your occupation and you elect to work in another occupation or you elect not to work at all, you'd be able to collect 100% of your benefit. It is the most expensive rider or definition, and it's the most sought after because it is so comprehensive. The next definition is transitional occupation. This one's a less expensive alternative to an own OC, and basically it has the same definition. You cannot perform the substantial material duties of your job, but you elect to work in another occupation. What it's going to do is it's going to take into consideration what you're working, what your income is at the new job you're working at, and what your income was prior to when you went out on claim. In this situation, they look at the 12 months before you went out on claim and what your earnings are, and we look at what the shortfall is between your new job and what you were making in your old occupation. We're going to have some examples, so just sit with me and we will go through each one of these and you'll see how they affect the outcome. Another definition, one that you've heard more often, is your occupation. Most individual plans, if we don't put the residual, or excuse me, if we don't put the own or the transitional on there, you're going to see your occupation. This one is most common. We use it a lot with middle income, office workers. Basically, same definition, unable to perform the substantial and material duties of your regular occupation, but you work in another occupation at a reduced capacity or have a reduced earnings. It's the least expensive option, and for most people like myself, it's probably sufficient. I don't really have a specialized skill set, but you know, someone who works like an engineering degree or something like that, this probably would not be one they would want to have on their disability policy. And lastly, the one that you'll see more often in a group policy is the any occupation definition. Benefits are only paid if the client is unable to work at any job. This is the one where people always say, am I going to have to flip burgers at McDonald's or be a greeter at Walmart? Excuse me, let me go back. This is one that clearly you do not want to have a physician, veterinarian, scientist, CPA, someone who has a very specialized skill set with just this type of occupation. Like I said, we're going to go through some case studies to illustrate these particular definitions so you have a broader understanding of them. The first one is going to be a neurosurgeon. He's making $225,000. He's not working by choice. Again, he could educate himself and do something else, and we're going to illustrate that in another one. But he has a disability plan that's going to pay him $10,000 a month. And here's the three different definitions and how they would be excuse me, translated if he should become disabled. The ONOC simply can't do his job, doesn't choose to do another, and he's going to collect the full $10,000. The transitional, similar, he can't do his job, and he's excuse me, and he's elected not to do any other work. He's going to collect the $10,000. And in the your OC, he's disabled and he's not working. He's going to collect the $10,000. This is probably the simplest one to understand. It'll get a little complicated in just a minute. Okay, same neurosurgeon who was making $225 is now working in a new occupation. Lots of times they're faculty if they work for a university. So he's taking on a teaching job where he's making $47,000. Most of these plans have a threshold of a loss of earnings of anywhere between 15 to 20%. Obviously, he's losing 79% of his, so he's going to be eligible for some benefits. Because he's not working in his occupation, the ONOC is going to pay him the full $10,000 a month. The transitional occupation is going to take into consideration that he is making some money, the $47,000, but it's clearly not enough. So he's going to get paid the full $10,000 a month from his disability, plus any money he makes, in this instance, from his new occupation as a teacher. And the same with the your occupation. Because the threshold is greater than 75%, he's going to get his full $10,000 a month benefit plus the $47,000 he's making as a teacher. Okay? Same neurosurgeon, making the same $225 before he became disabled, has now taught himself how to be a radiologist. And he's making $112,500 from his new occupation, and he's clearly doing much better, but he still has a 50% loss of earnings. So let's see how the three definitions affect that. Again, because he's not working as a neurosurgeon, the own occupation is still going to pay him his full $10,000 a month in benefit. The transitional, because again, he's not working as a neurosurgeon, but he is generating income as a radiologist, so he's transitioned himself into a new occupation, is going to be eligible for some benefits, but at a reduced amount because he is collecting 50% of his earnings. So what they're going to do is they're going to take into consideration that he's making $112,500 from his new occupation and subtract that from the $225,000 that he was making, and they're going to pay him the difference, which comes out to $93.75 a month. Okay? And in the last one, your occupation, because they're taking into consideration his 50% loss of earnings, the $5,000 comes from the $10,000 monthly benefit that he was getting with disability. They reduced that by 50%, so he's going to get his new income of $112,500 plus what he's making off the disability, $5,000 a month times 12 is $60,000. You combine those two together, and he's now generating an income of $172,500. In the last case study, our same neurosurgeon, but he's doing much, much better. He's perfected his skills as a radiologist, and he's now making over $206,250. If you calculate that, he only has an 8% loss of earnings. So let's see how the three definitions translate. Again, because he's working as a radiologist and not as a neurosurgeon, he's eligible to collect 100% of his benefit on the own occupation definition. With the transitional, because he's below the 15% loss or below the 20% loss of earnings, he's now only going to be eligible for $1,563 a month. What they're doing is they're taking into consideration his new income of $206 and subtracting that from the $225, and they're paying the difference. The last one, the your occupation, because his earnings loss is below the threshold of 20%, he's not eligible for any disability benefits. He'll just be collecting the income that he's generating from his new occupation as a radiologist. Okay. You might be asking yourself, what does it cost for the own occupation and the transitional and the your occupation? Well, we've answered that question for you. For the own occupation, net security is $61.81, the transitional is $45.79, and the your occupation is $42.74. Any one of these would be a bargain for your client to add on to their individual plan. Let's talk a little bit about occupation classes. Insurance companies look at occupation classes as a way to measure risk involved in your particular occupation. Obviously, someone who blows up buildings versus someone who works in a lab is a little bit different in terms of their liability, but those are things that the insurance company has to take a look at. So we've got an example of a business owner that we're going to look at. And this particular business owner is a president of a manufacturing company, so that's his title. So we wonder, what exactly do they manufacture and how many employees do they have? Well, it's an employee of one, and the industry is volatile chemicals. And where exactly is this business? His home basement. Well, that's going to look a little different than a president of a manufacturing company when an insurance company is taking a look at what his actual duties are, where he performs his duties, how many employees he has. So let's take this a step further and see what we need to know with regard to occupation classes. What an insurance company is looking for are what are the exact duties of your client. Are they office? Are they managerial? Or are they manual? Do they supervise? Do they supervise people who are doing manual jobs? Do they put a hard hat on at any time? Travel. Are they getting on a plane? Are they getting on a train? How much travel is involved in their job? And where are they going? Are they flying domestics? Are they going over to foreign countries? Are they going over to countries that obviously have some issues? So that's something that they're going to take into consideration. Something else is whether it's home-based or not. If it's home-based, there's no restriction if they're self-employed and out visiting clients 40 to 50% of the time. Remember, they're looking to see how often the person is at home versus out and about and how they're able to perform their job. Secondly, if they're self-employed in business for 2+ years. Most insurance companies, the look-back period is 2 years to see if they're able to be successful and if they're generating an income for at least 2 years. If they're not self-employed but work from home, it's not going to be an issue. In other words, if you work for Google and you're sitting at home and you're doing web design, Google has their eyes and ears on you, and they know what you're doing and what you're not doing and the production of your work. So if you're working from home, not really that much of an issue if you actually have an employer that you have to answer to. Now, let's talk a little bit about individual plans. We're going to talk about the individual plans because that's basically what the supplemental plan is. And Low Load has their own philosophy about how we design these plans and what features they need to have. There's going to be a lot of bells and whistles that could be presented on disability plans, but they're also going to increase the cost. So we kind of walk through them and talk through them and see which ones are applicable. So on an individual plan, some of the things that we think are important is that it be guaranteed renewable. Guaranteed renewable simply means that the policy cannot be canceled for any reason other than your client doesn't pay the premium. Another feature is that it be non-cancelable. That means that the insurance company, if they elect to increase a block of business or increase the premium on a block of business and your client has a non-cancelable policy, they cannot change the premium. The only way the change can occur on your client's policy is if they affect the change by exercising some sort of rider like the future income rider, which we'll talk about in just a minute. And lastly, it's portable. An individual plan is portable because you take it with you. If you change employers, it isn't affected. If you move from one end of the country to the other, it's not affected. It follows you wherever you go. Not sure if you heard that, but that was a little horn, and this is an opportunity for me to blow my horn a little bit here at Low Load. Now, what we're going to talk about is a couple riders that we feel are the most important that should be on any disability plan, and you'll almost always see them when I am asked to run a quote. The first one is called the Future Increase Option Rider, and what this one does is it simply allows your client to increase the monthly benefit on their plan by financial underwriting only. So they don't have to go through any medical underwriting. It's simply they have to provide financial documentation that shows what their current income is and why we need to increase the monthly benefit. Now, I personally do this on an annual basis with all of our clients. I send them an email and I notify them that this is the anniversary date and that we need to take a look at whether they've had an increase in their income and whether they have retained any other disability coverage in the past year. Based upon those answers, I'm then going to run a quote and present that quote to both the client and to the advisor. In addition, when I take a look at their policy, I'm also looking to see if they have any ratings or exclusions or anything else that we want to take a look at. For example, if the policy was issued as a graded premium versus a level premium, we always circle back every year and remind the client and the advisor that this is a graded premium and that it will be increasing every year, and that at some point we need to make a decision about converting it to a level premium. In addition, another rider that we think is important is the residual rider. The residual rider allows you to be paid if a client is not totally disabled. In other words, they're working part-time, but they're losing between 15 to 20% of their prior year earnings. An example of this is, let's say your client is diagnosed with cancer, and the prognosis is they have to have surgery, and they have to have chemo, and perhaps they have to have radiation. And this whole process could take in excess of a year, maybe 2 years. Well, during that time, clearly they're not able to work, but perhaps after they're coming off of all this treatment, they're able to ease back into work on a part-time basis. Well, without the residual rider, they would not be able to have any benefits paid to them whatsoever. But with the residual rider, if they're back to work maybe 15 or 20 hours a week, they can count on getting monthly benefit from their individual plan. Okay, let's talk a little bit about what's new in disability. Some of you have already known about this program because I used it already with a lot of clients who are residents, whether they're a physician resident or whether a dentist resident. Use it a lot with engineers, veterinarians. And what it is a program that several insurance companies have come out with, and it allows them to provide insurance to various occupations, for example these, whereby it's a designated amount such as $3,000, $4,000, $5,000, where they automatically can get that benefit plus a designated future increase option amount and some of the other riders that are on a typical individual plan. They know that these particular occupations have the capacity to make a lot of money in the future, or the potential to make a lot of money in the future. And what they do is they provide this designated benefit without any information regarding whether they have group insurance or the salary that they're currently making. It's almost like automatic as long as they don't have some sort of serious medical condition. So I ran some quotes to give you an example so you have an idea how much this is going to cost. I used a 32-year-old gastroenterologist who's in his first year of practice, and he'd be eligible for a base of $7,500 of monthly benefit and $8,500 of future increase option. And we ran it a couple different ways because, again, most of these individuals are paying an awful lot for their education. And when they first start out their practice, either as a, like I said, a physician or a dentist, they've probably got some school loans that they're going to have to pay down. So what we do is we provide them with an illustration that has the graded premium on there, which is lower than the level, and it gives them an opportunity to have a full-blown disability plan, but at a little lower premium when they need to pay back school loans. It frees up that money. So for our 32-year-old gastroenterologist, the level premium was $24.40, and the graded premium was $13.69. I also took a 32-year-old dental student who's in specialty school. He wants to be an orthodontist, and he was able to get $37.50 of base with $11,250 of future increase option. And his premium came out on a level basis at $2,053, and on a graded basis, $1,154. So again, keep in mind whenever you come across a client that is in these types of situations that we have special programs for them. And I can certainly run a quote for them. Another one that we have is the Business Owners Advantage Program. This provides an additional $2,000 a month of benefit. Oops, excuse me. This provides an additional $2,000 of monthly benefit if your clients qualify. A good niche for this particular product is your clients who are consultants, CPAs, doctors, dentists, attorneys, anybody who might be starting their own practice, like an attorney who maybe left a partnership, left a practice, and wants to start his own law firm. This would be an ideal situation for him to get an extra $2,000 a month in disability coverage. So just keep that one in mind when you take a look at some of your clients and they're in those particular occupations. Another one is the unemployment rider. This one probably was real popular a few years ago when there were so many people out of work. This one basically says that it's going to cover your premium for 1 year, regardless of whether you find a job or not. It's still going to cover your premium for 1 year. We ran a quote for our sales manager who's making $300,000, and it only added $63 to the cost of his plan. And if you circle back to the quote, you'll see that his premium was, I think, $6,300. So that comes out to being 1% of the annual premium. So just keep in mind, if that's something that you think your client might be interested in, we could put that rider on his plan. Another one is student loan. I talked about the student loan when I was trying to illustrate that we can offer the graded premium versus the level premium. The student loan plan simply says that they will cover up to 100% of your client's student loans to a maximum of $2,000 a month. And the way this works is they never even see the money. It's paid directly to the loan holder. And if the loan holder moves, because sometimes that's what individuals will do, they'll move their loans to a different location because they have a lower rate, this will follow wherever the loan goes. So just keep in mind if you come across your veterinarians, your doctors, or your dentists that might have some student loan, we have a product that can help with that situation. Another one is the lump sum rider. The way this one works simply means that if you have a client who has a disability plan that goes to age 65, and let's say that they go out on claim, and let's say they go out on claim several times, and during the times that they go out on claim, they're being paid a benefit, and it doesn't matter whether it's a total disability benefit or whether it's a residual benefit. Anytime a benefit is paid to your client, the insurance company keeps track of it, and once the insured reaches age 65, he will get 35% of whatever has been paid to him in benefits. The only caveat to this is he has to be alive. He can be disabled or he can be non-disabled, but he has to be alive. In other words, there's no survivor benefit. It doesn't get paid to his spouse or to his children or to a beneficiary. It can only be paid to him. So keep that in mind as something that might be attractive to your clients. Another situation that we're going to talk about that I think it's overlooked sometimes because we're focusing on the disability. But again, let's talk about those self-employed individuals, people who, like we said, are doctors, dentists, CPAs, accountants, consultants, people that probably would need to have business overhead if they should become disabled. The reason this is important is because individual disability coverage provides for a monthly benefit to cover your mortgage, your utilities, your car payment, your health insurance, things like that. There's not any money left over for the business overhead to keep your employees paid, to keep the rent paid on your office space, things like that. So what the business overhead does is it provides a monthly benefit for that purpose, to keep your business running so that when you come off claim, you have a business to go back to. Another piece that's involved with the business overhead is a loan protection rider. And what the loan protection rider says is if you've taken out a loan, let's say for an inventory or a capital improvement, or you bought a machine, or whatever the case may be, that you've taken out a loan, this particular rider will cover a loan up to $1 million, which has to include interest, but it will help pay that loan payment on a monthly basis for approximately 2 years until your client is back to work or has elected not to go back to work. But again, it's a little extra protection to make sure that they don't have to worry about how that loan payment is going to get covered. Another one that we're going to talk about is key person. We don't do a lot with key person, but I think if we talk a little bit about it now, you might be able to identify a situation where it would be applicable. Key person insurance basically says that if you have a key person within your organization and something should happen to them, that they should become disabled, what's going to happen to the business? For example, let's say you have a manufacturing business and you have a key salesperson that is generating most of the sales, and they should become disabled. Well, how are you going to compensate for the lost revenue that that person is bringing in? And or how are you going to replace that person? Well, what key person insurance does is it provides a monthly benefit if you want and a lump sum at the end of a set period of time, let's say 2 years. Most of the time, if a client isn't back to work within 2 years, they're probably not going to make it back, and you're going to have to make some decisions, or your client will have to make decisions about hiring another person and replacing them. And what happens is over the course of the 1 or 2 years, 18 months, whatever you choose, you're going to get a monthly benefit. And that monthly benefit is going to help offset the lost revenue. And then when we decide after a year or 18 months or 2 years whether that person is going to come back or not, you get a lump sum. And that lump sum is basically to hire a new person, use it to pay the services of maybe an executive search to find that new person to fill the job. But in any event, you have options with the key person, whether you want a monthly benefit, a lump sum, or both. Okay? Now, lastly, let's talk about other types of disability products that are available when individual insurance isn't a good fit. Oh, I'm sorry, I overlooked one, retirement security. Retirement security, you'll see I quote all the time. I'm trying to make all the financial planners out there aware of this particular product because, again, I think we need to make sure that your client is protected in all areas. And when a client goes out on claim, again, let's talk about where that money is going. It's probably going towards food, mortgage, utilities, things like that. And what's going to happen is that money is going to be funneled into necessities, and there's not going to be money left over to fund their IRA, to fund their 401k. And what happens is over a course of time, it may not be detrimental for a couple of years, but it could be significant if they're off for 5, 10, 15 years. And what the retirement security plan does is it simply says after 180 days of being disabled, there's going to be a certain designated amount of money that's going to be funneled into mutual funds or funds that are non-qualified, and it's put into a trust. And what happens is every month that money is going in there, it's going to obviously accumulate over time. At the end of every year, your client's going to get a 1099, and the 1099 is going to reflect any capital gains or distributions or any type of investment income that has been generated. And you're going to pay taxes on that. And as long as that money sits there, that's what's going to happen every year. You're going to get a 1099, and taxes are going to be paid on it, and that money becomes available at age 65, just like any other of your retirement plans. And it will be tax-free because you'll pay taxes on it all along. So I took a quote and I ran it on a 45-year-old invasive cardiologist, and we assumed that he was contributing $17,000 a year into his 401k. That means on a monthly basis, he'd be depositing $1,420 into his funds. And for the cost of that particular plan, it was $618.41 on an annual basis. So not really too expensive, and again, we can tailor this to the particular situation. You just need to let me know what exactly his contributions are. The only requirement is with one particular carrier, you have to be contributing for at least a year. Some of the other carriers, it's not a requirement that you be in a plan. It's just based upon federal guidelines on your client's salary. Okay? Okay. Now, let's go into what if long-term disability is not a good fit. And this does happen. There's special situations that occur when we just don't think long-term disability is the solution to your client's situation. And I'll tell you some examples of that. They might be maxed out on their group insurance. They might have an unusual or unique occupation. They might be too old to even qualify for disability insurance. It just depends upon the particular situation. So what we would do is suggest possibly a critical care insurance plan. Not sure, how familiar all of you are with critical care insurance. It's very popular in Europe. What the plan says is a little different than disability, because disability pays you on a monthly basis. Critical care insurance is basically insurance that pays you a lump sum of cash when a certain medical condition occurs. And I can't tell you all of them, but I'll run some off the top of my head. The biggest one being any type of heart disease, if you have a heart attack, if you're diagnosed with cancer, if you have any kind of renal failure, burns, coma, paralysis, if you lose 2 or more of your activities of daily living, anything that you would consider to be a catastrophic or, very serious medical condition. As soon as the diagnosis comes, your client is going to get a lump sum of money. The way critical care usually works for most carriers is it's 5 times your salary is what you're eligible for. So you can get anywhere between $10,000 to approximately $500,000. It just depends upon your client's particular situation, obviously their occupation, and what's available to them. So that's one of the things that we're looking at. Now, within the critical care insurance, different carriers offer different products. And, the thing to keep in mind is it does go beyond age 65, which is obviously when most disability plans are going to expire. But But some plans, they reduce the benefits at age 65. So if you had a $500,000 benefit, it's going to be reduced at age 65 to $250,000, and there is no reduction in the premium. And some will go to age 70, and that's a nice feature. But after age 70, the only way the plan would pay is if it's a long-term care situation where you've lost two, or your client has lost 2 or more of their activities of daily living. So not perfect for everyone, but again, there are certain situations where I think it can apply. We can also supplement traditional disability through our specialty underwriters, Lloyd's of London. Lloyd's of London we use an awful lot. I mean, I have 3 cases in this week that I've used Lloyd's of London. Basically, what we use it here is when we have a medical condition that either the client has been declined through disability, the conventional disability already, or we know already that there's no possible chance that they're going to get individual disabilities. So we farm it out to Lloyd's and have them take a look at it. Again, another situation is, you know, someone's maxed out their disability, or they have a unique occupation, or they make an unbelievable amount of money. We've done baseball players, we've done chairmen of banks. You know, it just depends upon the situation. So, you know, keep that in mind, that just because you don't think that they're insurable, that's not necessarily the case, because we might be able to offer them a different solution. One other thing I want to go back to on the critical care to keep in mind is if you have a situation where you have a high net worth client, and let's say the spouse doesn't work, and the client is concerned about what happens if his wife goes down and diagnosed with a serious medical condition, and they have 2, 3 children, who's going to take care of those children? Well, the critical care kind of fills that niche, because it will allow him to obviously collect a tax-free lump sum of cash, and he can use that to possibly hire a nanny, maybe have someone come in, you know, for her if she needs special treatment, whether it's therapy, a CNA, whatever the case may be. So there's a niche for that particular product, you know, and obviously the younger you are, the lower the premium is on it. So just keep in mind that we have something for everyone. And now we're just going to go into our summary. And again, I'm going to blow my own horn here because, again, if nothing else is taken from this particular webinar, I want you to remember my name, my number. Just call me. I'll help you recognize the gap, and I'll help you find a solution to fill it. Why it's important to cover it, we talked about some statistics, and you don't want to leave your client unprotected. We talked about whether it was taxable versus non-taxable. Taxable meaning the employer is paying for it. Non-taxable meaning your client is paying for it. We talked a little bit about why it's important to look at the employer disability coverage and whether it's going to cover the bonus and commission of your client. Most of the time they don't. So you don't want to leave your client unprotected in the area of bonus and commission. We talked about occupations and classifications and why it's important for you to provide me with as much detail as possible so that I can make sure that I'm classifying your client when I'm quoting them to give them the best classification, because it does affect their premium and it does affect their benefits. The higher the OCC class, the lower the premium, because the thought process is there is less risk involved in someone at a 6A than at an A. Okay? We talked about the 3 things that Lolo thinks is important to have your client's policy be guaranteed renewable, non-cancelable, and portable. Guaranteed renewable meaning they can't cancel the policy on you, they can't change the premium on it, and the portability, they can take the policy with them. We also have coverage available for, and we talked about all these, student loans, retirement, lump sum, BOE, business loans, and key person. And we also talked about when individual disability just isn't going to be the solution and how we can use critical care or specialty carriers. Now, remember back when I mentioned the statistics, the one that said that in 1 hour, 3,000 people have become disabled? Well, we're coming up on 1 hour in this webinar. Has any one of your clients become disabled? Okay, now I'm going to turn it over to Dina, and she's going to talk a little bit about what makes LLIS special.
Thank you, Kathy. That was an excellent presentation. We're going to open up the phone lines here for those of you who want to raise your hand on screen in just a moment, but we always like to take a minute to tell you a bit about who we are in case you're not familiar with us or you're not familiar with everything we do. We are not your competition. We don't do NASDAQ. We do insurance. We provide insurance education through these webinars, and then we have our annual LLIS Insurance Academy that's going to be in sunny Tampa in February. So for those of you who might be in the colder climate, come on down. You'll get 2 days of CEs and lots of good information to take home and put to use right away. We sponsor a lot of the organizations that you all are probably members of. We exhibit, we sponsor. We're proud to be a part of that. You and your clients are our only clients. We save you all time. We save you money. We save you surprises with all the pre-underwriting that we do as well. We have product specialists like Kathy in disability, and then we've got our long-term care specialists, annuity specialists, and so there's someone here that is key to every single one of the product lines that we help your clients with. We have what's called our AIM system. It's a proprietary system that keeps you and your clients in the loop as they go through their insurance process. And we've got our notification of term expiration. We've been doing that for quite some time, but we finally put a name to it. And that's to let your clients know when their term policies are going to be expiring or the conversion is going to be coming up. And that's even for if you have clients who have insurance policies that they didn't even get through low-load insurance services. If you let us know about them, we can put them into our database and it'll come up automatically and we can remind you all of that. And our little APE guy, it's our advanced premium email. That's our newest system to alert your clients that their premiums are coming due. And it's a real good double check because if your clients have moved and they didn't notify the insurance company, they won't get those notifications in the mail a lot of times. And we send those by email, so it kind of covers all the bases. And now I'm going to turn it back over to Kathy, and we will open up the phone lines. If you raise your hand, we'll open your individual phone line. So just one moment here.
Okay, I have one question from Nancy Bryant. She's asking, how is the premium determined for business overhead expense, or what is the typical amount you pay in a premium? Nancy, I can't tell you what the typical amount is. I can tell you how it's calculated. Basically, what they're looking for is what are the eligible expenses that your client has. You know, normally we run probably between the $20,000 to $50,000 a month in expenses. For a typical client that we run. So depending upon, you know, what that range is, that's where the premium is going to come in. You know, eligible expenses are employee salaries, rent, utilities, different office expenses, postage, things like that, you know, telephone. So we would have to take a look at it, and I would be able to determine which ones are eligible and which ones aren't, and then we come up with that amount, and then we run a quote based upon that. And then you choose if you want that benefit paid for 12 months, 18 months, 24 months. Usually they don't go beyond 24 months because if someone doesn't come off claim after 2 years, chances are they're not going to be coming off and be at 100%. Okay? Donald, your phone line is unmuted. What is your question? Donald, are you there? You had your hand up, Donald. Okay, I see your question. What happens if you change jobs? With the individual plan, it's portable. It does go with you, so you continue to pay your premium whether you move from one end of the country to the other or whether you've changed employers. It's a personal plan. It's just like your homeowner's insurance. It goes wherever you go. Okay, I have a question. Is there a general rule of thumb on continuing to pay on a DI when a client has sufficient assets to retire now, even if they are a few years away from stepping away? I would say if they're ready to retire, there really is no reason to keep the disability plan. If for protection purposes they want to reduce the monthly benefit. Let's say they have, you know, 7, 8, 9,000, and they want to keep maybe a couple thousand just in case. That might be an option. Keep in mind that insurance companies are willing to reduce benefits because there's no underwriting involved. But God forbid if you need more, and let's say you're uninsurable now, or you have a medical condition that makes you probably have exclusions or limitations, that's a lot harder to deal with. So my recommendation would probably be maybe look at reducing the monthly benefit, and then you know, eventually if he wants to get rid of it altogether as his assets continue to increase, that would be a possibility. Okay, what happens if a self-employed person's income goes down? Does the benefit maximum go down automatically? No, the insurance company has no way of knowing what their income is. What happens is again, the future increase option, I'm going to reach out to the client, and if the client tells me, which has happened several times in the last 4 years because of the economy, that they either haven't had a pay increase or they've had to take a pay cut, that's fine. We just don't increase their monthly benefit. But I don't send an email to the insurance company saying, hey, you know, this person's income has gone down. They don't care. They know that these things are going to happen. And you're paying for the benefit at whatever the amount is that your monthly benefit, you're paying the premium on whatever that monthly benefit is. So the only time it would come into play is if the client let the policy lapse, and then there's going to be some underwriting to reinstate it. But if they're just going along paying the premium, it's not going to affect anything. Any more questions? Well, thank you very much for tuning in. I hope we've educated you a little bit more about disability. But more than anything, I just hope you remember to call me. That's all you have to remember. Just call me. Thanks again, and be sure to tune in next month for our long-term care webinar. Have a good evening. Bye-bye.